The financial system, where Wall Street is kind of at the top, is supposed to be a support structure for the real economy. It's supposed to provide financing for individuals who want to buy a home, or for anybody who wants to start a company, grow a company, whether it's the corner store or whether it's, Caterpillar or Boeing, right? Starting in the 80s and really taking off in the 1990s, finance really started focusing on enriching itself, much more so than lending to the real economy. And the game was to get the biggest bonus as fast as possible. And that is hard to do when you're just lending to people to get mortgages to buy a home, or for somebody to start a small business or build a small business. It's even hard to make that kind of money when you're lending and financing medium and large businesses. But trading complex derivatives, now there's some money in that.
In February 1995, the Clinton administration proposed sweeping changes in the nation's banking system. It would repeal several federal restrictions, including the Depression-era Glass-Steagall Act, which forbids banks from underwriting securities or selling insurance.
All right, so after the Great Depression, Congress wanted to put a firewall between the investment banks and the commercial banks. They wanted to make sure that Wall Street could melt to the ground and the commercial banks wouldn't be touched. They passed a law, the Glass-Steagall Act.
I was with a guy for a long time who wasn't half the man that Will is, and he dumped me. Later I started seeing
I can
Will,
fill in the rest
and
of
then...
the story. Why can't it be fixed?
Listen, do you mind if we just talk
Yeah,
about...
Glass-Steagall.
The firewall, it worked?
It helped lead to the largest sustained period of economic growth in U.S. history. A 60-year expansion of the middle class, the largest increase in productivity, and the largest increase in median income. We also won World War II, put a man on the moon, and a computer in everyone's lab. And you know what happened next?
We cheated on the perfect guy with the guy who dumped us.
Yes.
Out of this process of emergency reorganization came the most important policy to be enacted, the Glass-Steagall Act, banishing the foxes from the chicken coop. No longer were the speculative and phony money games of the British Empire's investment houses, such as played by the crooks of J.P. Morgan, allowed to commingle with the legitimate and necessary functions of commercial banks. They were to be completely severed, by law, from all depository institutions. Any investment house officials that broke this law willfully were immediately subjected to financial penalties or jail.
1933, you had a law put into effect, the Glass-Steagall Act, which effectively prohibited banks from engaging in insurance underwriting and investment banking. That law stayed on the books until 1999.
If we're still operating in the 1930s or 40s in terms of our financial services in this country, then we're going to find major industries in this country going offshore.
There's been a major conscious process of financialization of the economy and exporting of productive industry. That's very conscious, and this is not particularly obscure why. By about that time, it was possible to make more profit in shenanigans of money manipulation than in doing anything productive.
Traditionally, prior to the 1980s, the primary occupation of banks was in taking deposits and lending them out to businesses, thus making them strongly integrated with real economic activity. However, recent research has shown that only approximately 15% of the financial flows coming out of the largest financial institutions in the U.S. are now going to business investments. This is a profound shift in what the financial system does and is that departs significantly from our traditional economic models for the role of finance within the overall economy. Much of the money that has been diverted from real economic activity has gone into the development of the global derivatives market. A key feature of financialization as it has evolved over the past decades has been the proliferation of derivatives of all forms. In the year 2006, derivatives trading reached a level of $1,200 trillion, dwarfing the output of the real global economy that was approximately $50 trillion at the time.
was that the political pressure just dismantled the regulatory apparatus, with the support of economists, incidentally, working with economic theories that, I mean, it's astonishing that they're not ashamed of themselves.
You know, the world trusted Rubin and Greenspan, so why wouldn't Clinton? You know, and the market was doing great, and the country seemed to be doing great.
Big day on Wall Street as stock prices return to territory.
Party on Wall Street today, posting a triple-digit gain.
Trading at 5 times its offering price.
9 for total 41,000.
Extremely active volume, 55 million shares changing hands, and market revenues.
2,500 knots.
These were the euphoric go-go 90s.
That fiscal deficits today are combined with an array of other financial imbalances that are A, very substantial, and B, very substantially worse than they were in 1993. We have a zero personal savings rate. We have about something under a 2% of GDP net national savings rate.
Because if you look at the business cycle, for example, euphoria drives it up like this, and then fear collapses it.
The Dow Jones Industrial Average gained 91 points today.
$300 a share.
Santa Claus arrives early on Wall Street.
But in Washington, there was one agency that looked at the bull market with some skepticism. Buried deep in the bureaucracy, the Commodities Futures Trading Commission, CFTC.
Federal Reserve Chairman Alan Greenspan told Congress today the U.S. economy is the best he's ever seen.
By spring of 1998, the idea of tougher regulation seemed out of step with all the good news.
Current economic performance is as impressive as any I have witnessed in my near half-century.
Extremely active volume, 55 million shares changing hands, and market revenues.
2,500 knots.
These were the euphoric go-go 90s.
Well, you know, the mid to the late 1990s were a very ripe boom period. It was the most robust portion of the tech boom.
Internet fever has not subsided.
On the money tonight, internet fever again.
She was determined that her agency would investigate fraud at the first opportunity. One area that caught her attention was a new and highly lucrative market, over-the-counter derivatives.
She starts to realize that there's this whole world out there of what are called over-the-counter derivatives that are essentially unregulated. It's not even that they're unregulated, it's that the government doesn't even know what's going on.
My staff began to say how big this was and how little information they had about it.
On Wall Street, they described it as a black box. Only the parties involved in a deal knew what was happening.
Over 100 years ago, my grandparents came from Korea to work in the sugarcane fields of Hawaii. They didn't come looking for a government handout. They came looking for freedom and opportunity.
Let me first just let you in on a little inside information. Nobody had ever heard of credit default swaps when we debated the Commodity Futures Modernization Act.
My question again is, what are you trying to protect?
We're trying to protect the money of the American public, which is at risk in these markets.
That summer of 1998, Bourne testified 4 times before hostile congressional committees.
They were hearing from very respectable sources that there was no problem, and they chose to rely on those people. And I think that was understandable. I think it was unfortunate, but I think it was very understandable.
I thank each one of you for coming and for your testimony.
Now, in plain English, derivatives are, in some situations, nothing more than legalized gambling, sometimes gambling with your grandmother's pension fund. Now,
in the financial world and derivatives, it's as though nobody gave a damn about safety. And they just let it balloon and balloon and balloon in usage and number of trades and size of trades. And that ballooning is aided by this false accounting, where people are pretending to make money they're not really making. I regard that as very dangerous.
what do you think subprime mortgage-backed securities are? You probably heard of that spoken of quite frequently. They are derivatives, okay? So the bank lends money to a home buyer. The bank sells the mortgage to Fannie Mae. Fannie Mae sells that mortgage in secondary markets. The hedge fund splits up that mortgage-backed security into higher and lower risk portions.
And an absolutely key person, Larry Summers, who was then Deputy Treasury Secretary, called up Brooksley Born. And he said, Brooksley, if you regulate over-the-counter derivatives, you will cause the greatest financial crisis since World War II. I have 13 bankers in my office, Brooksley, who say this. Now that's the 13 bankers. The 13 bankers who, I don't know if they're true, if they were really there, or if that's, just something he said.
However, by any calculation, the derivatives market is quite sizable and significant in the overall picture of worldwide investments. Derivatives, as the name suggests, they are derived products, built upon existing assets and other derivatives. As of now, there are thousands of such product categories ranging from simple swaps, futures and options to complex, exotic ones which would give you a good headache trying to figure out what exactly they are. Basically, it's just a huge gamble by the financial community, a bet if you would like.
In 1999, at the urging of Summers and Rubin, Congress passed the Gramm-Leach-Bliley Act, known to some as the Citigroup Relief Act. It overturned Glass-Steagall and cleared the way for future mergers.
I think this is a very good bill. We can view the same bill from different perspectives. I view this bill as a great codification and regulation of the existing financial services system and the future dynamic financial services system, a financial services system that has been brought about primarily through the unbelievable breakthroughs in technology and the marketplace.
This will, first of all, save consumers billions of dollars a year through enhanced competition. It will also protect the rights of consumers. It will guarantee that our financial system will continue to meet the needs of underserved communities. It is true that the Glass-Steagall law is no longer appropriate to the economy in which we lived. It worked pretty well for the industrial economy, which was highly organized, much more centralized, and much more nationalized than the one in which we operate today. But the world is very different.
In 1972, had approximately 110 total personnel, one office, and capital of $12 million. Now, Morgan Stanley has 50,000 workers and has capital of several billion and has offices all over the world.
I know of no set of supervisory actions we can take that will prevent people from making dumb mistakes. I know of no piece of legislation that can be passed by the Congress which would require us to prevent them from making dumb mistakes.
Now, the Community Reinvestment Act was set up to say to the bank regulators, look, you guys go in and look at these banks and tell them, you got to take some of your money and invest it in inner cities, in neighborhoods, and with people who otherwise would not get it, so they have a chance to build homes, to build businesses, to create jobs, to build neighborhoods. In the 20-year history of the Community Reinvestment Act, 85% plus of the money loaned out under it to poor inner city neighborhoods have been loaned in the 5 years since I've been president.
The highest order of business before the nation is to restore our economic prosperity.
In 1981, President Ronald Reagan chose as Treasury Secretary the CEO of the investment bank Merrill Lynch, Donald Regan.
Wall Street and the president do see eye to eye. I've talked to many leaders of Wall Street. They all say we're behind the president 100%.
The Reagan administration, supported by economists and financial lobbyists, started a 30-year period of financial deregulation. In 1982, the Reagan administration deregulated savings and loan companies, allowing them to make risky investments with their depositors' money.
Now, up until this point, Fannie Mae was the most important mortgage company in the world. What Fannie Mae did was that they would buy loans from lenders and other companies, repackage them, and then sell them to investors. The lenders would get fresh capital that they could use to make more loans. Investors would get these great mortgage-backed securities, and Fannie would take a fee for guaranteeing that the borrowers were going to pay off their debts. So in a lot of ways, they're the lubricant that makes the housing economy go.
First, homeowners borrow money from banks or other lenders. Then, Fannie and Freddie buy these mortgages and package them into securities. Then they sell those securities to investors. Investors buy them because they're considered safe, because Fannie and Freddie take on much of the risk. Lenders and banks benefit too. Since the government takes on much of the default risk, lenders can make more loans to more people. Together, Fannie and Freddie now back about half of new U.S. mortgages. So, why do some want to change the two companies?
But here's where the difference lies. Commercial banks deal with individuals and small to mid-sized companies, giving out smaller sums of money like individual mortgages and small business loans. They make their profits through the interest they charge. On the other hand, investment banks take much larger risks. They deal with huge companies and high-risk startups, acting as a bridge between companies and investors. In the process, they can earn a huge amount in fees.
Chris? God damn it. Sorry. This is your basic mortgage bond. All right? The originals were simple. They were just thousands of AAA mortgages bundled together, guaranteed by the US government. The modern ones are different. They're private, and they're made up of layers of tranches. The highest level AAAs getting paid first, the lowest rated Bs getting paid last, taking on defaults first. Now, obviously, if you're buying Bs, you can make more money, but they're a little risky. Sometimes they fail. Chris? Somewhere along the line, these B's and double B's went from a little risky to dog shit. Where's the trash? Behind you. I'm talking rock bottom FICO scores.
JP Morgan Chase, maybe you've heard of it. If it was a country, it would have the 8th largest economy in the world. Bigger than Brazil, bigger than Canada, bigger than Russia.
Hi, I'm Justin Johnson from Attapugus, Georgia, and I've always wondered, how did banks become too big to fail?
Enron used to be the 7th largest corporation in the United States, at one point valued at over $70 billion. As of 1997, however, they started losing money and accumulating debt. Instead of admitting their mistakes and making changes, Enron executives decided to hide the losses through accounting tricks because they didn't want the Enron stock price to go down. Risky decisions kept being made, and the truth was hidden under the rug. As of 2001, however, the media started wondering whether or not Enron was overvalued. This obviously put a lot of pressure on Enron stock prices, which used to be as high as $90.75 per share. Insiders decided to cash out and started selling lots of shares, and prices kept falling until they ended up at below $1 in late 2001.
Please help us keep Texas a place where free enterprise and limited government keeps the American dream alive for us and for our children and our grandchildren.
Ken Lay started Enron in 1985 as a regional pipeline operation. He turned it into a trading energy company, buying and selling electricity and natural gas. The company's revenue exploded from $5 billion a year to $200 billion a year with 20,000 employees globally. It became the 7th largest company in the country. But in the process, billions of dollars in debt was kept off the company books, and profits were falsely inflated. Enron CEO Jeffrey Skilling served 14 years in prison. Ken Lay died of heart disease less than 2 months after his conviction. Chief Financial Officer Andrew Fastow served 5 years.
The things that make Texas great are the things that make America great. Not government, but opportunity and freedom.
Free enterprise, limited government, personal responsibility.
In the 20s, we had 30,000 banks in the U.S. By the 70s and 80s, we had about 15,000. And today, we have about 5,000. Now, nobody's saying that we lived in a bank utopia back then, okay? We had a lot of banks, yes.
The market's in an itsy-bitsy little gully right now. It's like everybody said, okay, that was crazy, let's just all calm down. I sold that house for $350 the year it was built. 2 years later, $480. Then $585, maybe 18 months ago. This couple bought it for $650 last year. He'd let it go for that. Hi, John. It will break his heart, but he'll let it go.
Why is he selling?
Neither one's working right now.
Orlean, you'd say they're motivated, right?
As motivated as one can be in this neighborhood.
The bank owns our hedge fund, but we're not really a part of it. We invest in financial service companies, and we're trying to understand the residential mortgage business.
How many loans do you write each month?
Yeah, about 60.
Yeah. What was it 4 years ago?
10, maybe 15.
Yeah, I was a bartender. Now I own a boat.
You own a boat. So how many of these are adjustable rate mortgages?
Well, most.
Oh, yeah?
Yeah, I'd say about 90%. Yeah, the bonuses on those skyrocketed a few years ago. Adjustables are bread and honey.
So do applicants ever get rejected?
Seriously? Look, if they get rejected, I suck at my job.
Even if they have no money?
Well, my firm offers ninja loans. No income, no job. You know, I just leave the income section blank if I want. Corporate doesn't care. These people just want homes, you know, and they go with the flow.
Good for you.
Your companies don't verify.
If I write a loan on Friday afternoon,
Big bank is going to buy it by Monday lunch.
Yeah, same here.
Do people have any idea what they are buying?
I focus on the immigrants, you know? Once they find out they're getting home, they sign where you tell them to sign. Don't ask questions, don't understand the rates.
Fucking idiots.
Yeah.
And you target immigrants too?
Their credit actually isn't bad enough for him.
Look, I'm a yield guy. Okay. I make $2,000 on a fixed rate prime loan, right? But I can make $10,000 on a subprime adjustable. Trust me, I'm not driving a 7 Series without strippers. No one on the pole has good credit, and they're all cash rich.
I think I read Warren Buffett say something like that. No.
What?
Not right.
Who's Warren Buffett?
Okay, so strippers like exotic dancers.
Yeah.
The next one, people think whatever's happening now is going to continue to happen into the future. During the real estate boom, markets were going up and up, and people thought they would never go down.
So people who are watching and think that I won't lose will make a side bet. Now this is the first synthetic CDO.
I love Selena Gomez. I bet you 50 million she wins, and I'll give you a 3-to-1 odds.
3-to-1 odds? Okay, I'll take that bet. Now, somebody else is going to want to make a bet on the outcome of their
Bet you
bet.
50 million she wins.
That will lead to synthetic CDO number 2.
Hey, I bet you 200 million that lady in the glasses wins that bet.
She probably will win, so I want a great payoff.
How about 20-to-1?
Deal.
And this will go on and on with more and more synthetic CDOs.
And we can transform an original $10 million investment into billions of dollars.
Some economists blame Graham in part for the crisis itself. As Senate banking chairman, Graham consistently weakened federal regulations. His deregulation of energy commodities first helped his wife's employer, then killed it. In 1999, the Graham-Leach-Bliley Act, which McCain voted for, broke down the decades-old wall separating commercial banks, heavily regulated, from the wild and woolly world of investment banking, a wall erected in 1933 to prevent a repeat of the Great Depression. 1 month after Graham knocked that wall down, UBS bragged to investors that his bill would liberalize restrictions. UBS bought PaineWebber the very next year and hired Graham before he even left the Senate. Graham's deregulation helped set the stage for an explosion of banks slicing up subprime mortgages, bundling them with other mortgage slices to hide the credit risks, and selling mortgage stew to other investment firms. That gave lenders powerful incentive to make as many loans as possible, regardless of risk, because they could still turn around and sell those mortgages almost immediately. Graham himself said he was totally unaware just how many bad mortgages his own company bought. At last count, UBS had lost $37 billion in the mortgage crisis and plans to lay off 5,500 people next year, primarily in the U.S.
Let's talk about the speed with which we are watching this market deteriorate. We're red everywhere, essentially, down by 4-5%.
We're down over 16%. Dow at the same time has fallen about 18%.
The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
2-year no yields went from 190 to 166 in the blink of an eye.
On the NASDAQ, everything and more has been completely wiped out.
It was the worst day on Wall Street since the crash of 1987.
From the financial capital of the world, the opening bell is going to ring in 5 seconds, and to be honest with you, we wish it wouldn't.
Traders here working the phone say a lot of their customers are freaked out, waiting to see how low
the Dow will go. They're focused on the Dow, not so focused on OPEC. Yes, OPEC did cut production by 1.5 million barrels per day.
Really, you're seeing just broad-based declines across all of the major technology sectors. Apple's under pressure, Yahoo down 8.5%, Cisco 6.5%, Research in Motion 10%.
And we're not getting the bid wanted. We're not getting the stop trading, and we see where the buyers are. We're just, every day they're pounding it.
The heightened financial turmoil that we have experienced of late may well lengthen the period of weak economic performance and further increase the risk to growth.
Can't look at it after you buy it because it's so horrible.
But we've had an 8-day losing streak in the Dow that in percentage terms puts it on par, close to the loss suffered in that crash in 1987, close to that percentage loss those 2 days in 1929.
What started in America last year has now spread to every part of the world.
We're down 9% today. The Xetra DAX over in Frankfurt is down by 9%. The Paris market down by 9%. Austria, which was briefly suspended earlier on in the day, is down by nearly 11%.
This market is as volatile as you'll ever see.
Traders saying this is the craziest day they have ever seen in these markets. Veteran traders saying they've never seen anything like it. The movement in oil prices so fast, so fast.
Seconds to go until the start of trading at the New York Stock Exchange, and stocks are set to kick off lower, a whole lot lower.
eBay is down 6.5%, and really you're seeing just broad-based declines across all of the major technology sectors. Apple's under pressure, Yahoo down 8.5%, Cisco 6.5%.
I hate to do this right now, but I'm going to have a press call first thing, and I really don't know what I'm going to tell them.
Okay, here's how you explain it. Wall Street started bundling home loans together, mortgage-backed securities, and selling slices of those bundles to investors. And they were making big money. So they started pushing the lenders, saying, come on, we need more loans.
The lenders had already given loans to borrowers with good credit, so they go bottom feeding, they lower their criteria.
Before, you needed a credit score of 620 and a down payment of 20%. Now they'll settle for 500, no money down.
And when they ask me why they did that?
Fees. Hundreds of millions in fees.
We give you money, you lend it out. It will unfreeze credit, stabilize the banks, restore confidence. Everyone will be better off with more capital in the system, and that is why all 9 of you will participate in the program.
So why am I in this room talking about bailing you out?
The stronger banks will serve as cover for the weaker banks. If just some of you take it, the money is a signal that a bank is too weak to survive. The market will devour it.
How much are we talking about?
125 billion. Bank of America, 15 billion. Bank of New York Mellon, 3 billion. Citigroup, 25 billion. Goldman Sachs, 10 billion.
Last fall, in the span of just 6 days, Wells Fargo flip-flopped, first rejecting, then accepting a deal to buy Wachovia. What changed so drastically in less than a week? 2 things. First, Treasury Secretary Henry Paulson quietly issued a document revising the tax rules, giving enormous benefits to some banks that buy other banks. For Wells Fargo, it could be worth up to $25 billion. Then Congress passed the giant bailout that would provide $25 billion in direct funds to Wells Fargo. The very same day the bailout passed, Wells Fargo announced the surprise turnaround to investors. It would buy Wachovia after all.
This is, of course, a very exciting moment in the long history of Wachovia and Wells Fargo.
Wells Fargo became one of 9 banks to receive bailout money and quickly closed deals with other banks.
It was a record amount, $700 billion to rescue the country's failing banks. Weeks later, and with the economy still in turmoil, many are wondering what happened.
So now we're talking about sort of trying to put the toothpaste back in the tube. We're trying to say, wait a minute, okay, the money's gone. Where did it go?
A congressional oversight panel is looking into just that, finding out what Treasury has done with the billions it's already spent.
It is entirely appropriate
for the American people to know how their taxpayer dollars are being spent in private industry.
Meanwhile, the Associated Press contacted 21 banks that received at least $1 billion in government dollars and asked 4 questions. How much has been spent? What was it spent on? How much is being held in savings? And what's the plan for the rest?
None of the banks responded. We didn't get one answer, not one straight answer.
My voice was not popular. The financial markets had been expanding, innovation was thriving, and the country was prosperous. The financial services industry argued that markets had proven themselves to be self-regulatory, and that the role of government in market oversight and regulation should be reduced or even eliminated. All of us have now paid a large price for that fallacious argument. We're in the midst of the most significant financial crisis since the Great Depression.
You have been a staunch advocate for letting markets regulate themselves. And my question for you is simple. Were you wrong?
Yes. I found a flaw, but I've been very distressed by that fact.
You found a flaw in the reality?
A flaw in the model that I perceived is the critical functioning structure that defines how the world works, so to speak.
None of us anticipated the full ramifications and extent of the crisis, and so in that respect, we were late. We then responded very aggressively. I think overall we were successful in stabilizing the financial system. And
what's your view of the ability of these enormous derivatives dealers to successfully manage their companies? At year-end 2009, the OCC said that J.P. Morgan's position was $78.6 trillion in notional amount.
It's hard for me to imagine a system, and it's hard for me to imagine a regulatory system that can supervise something like that. And
from the start of the financial crisis in 2007 through March of 2009, the Fed loaned or guaranteed the banks some $7.7 trillion, about half the value of all the goods and services produced by the U.S. economy. That's 11 times the $700 billion in aid provided by the Treasury Department's better-known Trouble Asset Relief Program, or TARP.
The 5 banks involved are Bank of America, Wells Fargo, J.P. Morgan Chase, Citigroup, and Ally Financial. President Obama hailed the deal at a press conference on Thursday.
We have reached a landmark settlement with the nation's largest banks that will speed relief to the hardest-hit homeowners.
So things went very well, and then the economy collapses, and so all of a sudden people are saying, well, it was Alan Greenspan's fault because he should have anticipated this. Did you think that was fair?
Nobody forecast the 2008 crisis. One of the things I put in the second book I wrote was how the IMF missed it. The Federal Reserve missed it. You go down a whole series of the major forecasting.
Well, everybody got it wrong, let's say.
Banks have seen it fit to use the money to buy other banks, simply to put into their savings, or to grant these bonuses they've given to their officials.
But let me tell you, when we gave them money, when we gave the banks money, they still weren't loaning any money.
We definitely felt alone. We were like, oh my God, we are the only people dealing with this problem.
What we've seen over and over again is that homeowners individually stand almost no chance to get a significant modification of their loans.
Unusually high foreclosures have left the country in the worst housing downturn since World War II.
Congress approves an historic bailout bill.
President George Bush has already signed the revised $700 billion bailout.
The bailout money was supposed to be used to jumpstart the economy by re-energizing lending, but some of the banks can't tell you what they did with it.
So the Obama administration has set a goal of preventing 9 million foreclosures as a part of this plan. That's a very ambitious goal. Some are unclear whether that's realistic.
Good news for millions of homeowners facing financial trouble. The Obama administration has launched a new program dubbed Making Home Affordable.
This is the most dramatic step the government has taken so far to tackle the foreclosure crisis.
The program has two parts. One will work with lenders to modify the loan terms for up to 4 million homeowners. To qualify, eligible homeowners need their most recent tax return and 2 pay stubs, as well as an affidavit of financial hardship. It only applies for loans made on or before January 1st of this year and for mortgages less than $730,000. The second part of the program will refinance up to 5 million homeowners into more affordable fixed-rate loans. Only those whose loans are held by Fannie Mae or Freddie Mac are eligible, and they have until June 2010 to apply.
But there are a lot of borrowers out there who paid much more for their homes than they are now worth. And if they're in that situation, they're not likely to qualify for either piece of this program.
But if they do qualify, officials are asking borrowers to be patient.
The amount of requests for this kind of aid is going to be overwhelming for mortgage companies, and there's going to be millions of people around the country who are asking for help.
Meanwhile, another part of Obama's housing plan is already in the works. House Democrats agreed Tuesday to narrow proposed legislation that allows bankruptcy judges to change the terms of mortgage loans for borrowers in debt. A full vote in the House could come as early as Thursday. Diane Kepley, The Associated Press.
Stockton and its surrounding cities make up the foreclosure capital of the nation.
$75 billion nationwide that's going to help 4 million homeowners. And since we are at the center of the foreclosure crisis.
In nearby Lathrop, KB Homes advertises prices from the 100,000s. But in this area not too long ago, the average price of a home was $500,000.
Bank of America, J.P. Morgan Chase, Wells Fargo, Citigroup, and Ally Financial are the 5 major mortgage lenders who've agreed to reduce loan amounts for nearly 1 million households. And they'll send $2,000 checks to 750,000 Americans who were improperly foreclosed on.
You throw enough money at a couple institutions, they're not going to collapse. So that's why the program was supposed to help reinvigorate the economy. It was supposed to restore lending. When they got this money, they were actually supposed to put it back into the economy so we don't have the sluggish recovery we have today. And most importantly, it was supposed to help struggling homeowners. This was part and parcel of why the Democrats, particularly in the House, voted for TARP, was the promise to help foreclosure relief for so many struggling homeowners.
There was some foreclosure relief for people. 1 million home, I think, is the number.
I think the current number now is around 800,000, which is 1/5 of what the goal was supposed to be.
Where's my bailout?
Where's my bailout? So, where's my bailout?
Contact your congressional representatives and ask them, where's my bailout?
About 90% of the executives who were on the job running these banks at the height of the subprime mortgage boom in 2006 are still on the job today. And they're the ones that the government is counting on to turn this economy around.
Business professor Peter Morici.
They should be fired. These executives should be fired. Everyone knew we were making a lot of bad mortgages.
Congress has approved giving banks $700 billion without putting any conditions on it. Unlike the auto industry bailout, there was...
At Countrywide headquarters in California, she has the exclusive interview with the company's chairman and CEO. We want to turn it over to her now, Maria.
Hi there, Trish, and thanks very much. We are on the trading floor right now of Countrywide Financial, and I'm here with Chairman and CEO Angelo Mazzillo. Angelo, nice to have you with us.
Nice to be with you. For a long-term shareholder, this is the best deal in the world. For a long-term shareholder of Countrywide, the best deal that they can have. To put Countrywide back on a strong footing so we can move forward.
What will determine whether this, along with the $11.5 billion drawdown, the credit line, will in fact be enough?
Well, first of all, let me kind of comment on a couple of things. One is just the irresponsible behavior on a part of that analyst from Merrill Lynch, that Countrywide was going to go bankrupt to withdraw their money. It was all caused by that individual at Merrill Lynch and had no basis in fact whatsoever. We have a very strong bank, well overcapitalized, access to the Fed window for whatever they need.
No.
Our 10 most wanted list, Angelo Mazzillo, founder of Countrywide Financial, which made him king of the subprime mortgage market. Here's 360's David Mattingly.
When it came to the American dream, no one was better at selling it than Angelo Mozillo. As founder of the mortgage giant Countrywide Financial, California, Countrywide's base was among the worst, with, in July, a staggering 1 in every 69 households foreclosed on.
Countrywide is a gross example of the ripoff that we now are paying for.
But California Congresswoman Maxine Waters believes Mozillo was all about profit and thrived on lax regulations.
Mr. Mozillo basically tried to have people believe that he was only helping these poor people and these minorities get into a home. That is not to be believed. He was making extraordinary amounts of money.
Mozillo retired after Bank of America bought Countrywide and put a stop to subprime loans. Mozillo defended his $44 million retirement package.
In extremely complicated situations, you know that something has gone badly wrong, but you can't prove somebody guilty beyond a reasonable doubt.
The New York State Attorney General says that Citigroup, Merrill, and 7 other banks, which got $175 billion in tax-funded bailout money, paid out $33 billion in bonuses. The report by Attorney General Andrew Cuomo says that when banks did well, employees were paid well. That's okay. Cool. When they did poorly, employees were paid well. And when they did really poorly, they were paid well. Concluding that the bonus structure had no rhyme or reason, which is indeed the title of the report.
Thank you. So AIG has received about $70 billion in TARP money, about $100 billion in loans from the Fed. Do you know where the money went?
Hundreds and thousands, maybe thousands of counterparties, but I'm sure that the supervisors involved and the people at the Fed who were at the front lines of this stuff would have access to detailed information.
So they knew who was going to get the money, the counterparties.
Well, I think they could have known. Whether they knew at the time, I'm not sure they knew it, but of course they would have access to that.
Do you know if they spoke with any of the counterparties?
In what sense?
In any sense.
Right, but maybe so you finish. So where are you going? What would you like? What would you like to know?
I just want to know: did Treasury have conversations with any of the counterparties who ultimately profited?
I was not the Secretary of Treasury at the time.
We just finished our auto report, and Chrysler and GM, insolvent company, AIG, insolvent company. Chrysler and GM have bondholders, unsecured creditors, secured creditors, and employees, and they all took big haircuts. AIG had people holding credit default swaps, and they took no haircut at all. They ended up with money from the federal government, 100 cents on the dollar, and I'm trying to understand why those two are different from each other.
But you've spent your life thinking through these things, so you understand this better than many people.
And that the role of government in market oversight and regulation should be reduced or even eliminated. All of us have now paid a large price for that fallacious argument.
Let's start with income inequality.
Okay.
You're going to say yes, please.
So income inequality, this is something I think we've all thought about. You know, I was working on that topic when I was still at Goldman Sachs, and
in which direction?
You're working on
increasing it.
Yeah, make it wider.
But I think.
I would say.
I think.
But in all seriousness, I looked at that as something that was
I was serious.
What was a huge issue, and so we talked.